Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, there's some interesting stuff happening in money market funds right now. And the flows are something that I really want to spend some time talking with you about because, man, it is just eye-opening what's happening here.
Yeah, I mean, money market funds have grown by well over $500 billion in the first quarter. March in particular was ridiculous. Listen to this stat, Joel. If you ranked all mutual funds by March flows, the top 28 would be money market funds and 73 out of the top 100. This is a stat that James Seyfert on my team found. And again, think about this. This is basically what ETFs took in all of last year. So this is big boy flows, and it's basically diverted. We're a bunch of ETF analysts, but we've been completely diverted over there because this is a big deal. And obviously, the reason is because you can get 4.7, 4.8% with basically risk-free when obviously contrasted with a lot of banks will only give you 50, 60 basis points in your savings or checking account. So that spread has become the story of the year, in my opinion. It does link to the whole bank story. And I do think banks are now going to have to probably raise their rates at some point. And also, the appeal of a 4.8% yield in a money market fund has actually taken away a lot of money from equity flows because there now is like an alternative. And so this has become, again, it's not just money markets, impacted everything. And it's, again, it's diverted all of our attention.
And to be clear here, money market funds, we're talking about cash, right? Like something that is like so basic and boring, right? But yet cash has become king?
Yeah, sometimes cash is the sexy thing or the shiny object because other things are struggling. But what made Q1 interesting to me is that equities were up 7%. You know, unlike last year, they were down. They were up this year. But the idea, I think equities now have to work much harder to get your money. So if they have another good quarter, I could see maybe some money shifting out. But again, almost a 5% yield, guaranteed banked. The NAV stays at $1. That's really compelling. And what we also found was how lucrative this is for the asset managers. Unlike other areas, the Vanguard effect isn't big here. A lot of these money funds charge 35, 40 basis points, and they took in a ton of money. Vanguard does have one, but it's sort of an interesting area where the Vanguard effect is not really in play as much. And we explored that too. So there's just so many interesting angles to this story.
Also, Eric, I am not going to be here for the rest of the episode because I have to go to my brother's wedding in Central Oregon.
Yeah, what are you running out to catch a flight right now?
Not quite yet, but it's going to happen soon. So nice. You're going to have some guests on and you're going to do all this by yourself. You're a big boy. I'm sure you can figure it out.
Yeah, I'll miss you, but I'll be okay. Is this your older or younger brother?
4 years younger. First time getting married. He's
Wow. Wow.
Bend, Oregon.
And what happens there? I'm picturing like stagecoaches for some reason.
No.
Oregon Trail.
You played Oregon Trail. Yeah. It's the high desert, man. The air smells like juniper. The golf is great. When the weather's a little bit nicer, you'd be river rafting or something. It's like an outdoor paradise. It's truly a special place. This time on Trillions, cash is king.
All right, so today here we have Katie Greifeld from Bloomberg News, Mike Regan from Bloomberg News, and Nafis Smith, Principal and Head of Taxable Money Markets at Vanguard. Welcome, everybody.
Thank you. It's good to be with you this morning.
Yeah, thanks for having me, Eric.
I'm thrilled to be here.
So, Mike, let's start with you. There's a Business Week cover. You wrote the cover story. Our team was passing it around. We thought it was great. The cover has the number 4, and it's like jacked. It's got like a 6-pack. It's real strong. And it speaks to the 4% plus yields on money funds as if all of a sudden something that is usually boring is really interesting. And so just talk about your article and what you some of the conclusions you came to.
Yeah, this was one of those Joel ideas where I think he and his friends probably having the same conversation that me and my friends and everyone's having now these days is that, wait a minute, all of a sudden you can get a nice little yield in something as simple as a money market fund or, as my story focused on, just regular old bank savings accounts. Remember a couple of years ago, you basically needed to buy junk bonds to get 4% yield. And now you can get them in something as theoretically as safe as a bank savings account. But what's I find very fascinating is that yield in this point in time is high enough that people, it raises eyebrows and they're almost looking at it like a risky asset. And I'm like, no, this is a bank savings account. This is what banks are supposed to do. But we've been trained to not expect yield from these vehicles, whether it be, a simple savings account or a money market mutual fund from that ultra long era of 0% interest rates. So one really fascinating thing that I noticed in the reporting of the story is that last year deposits at U.S. banks actually fell for the first time since like the 1940s. They just tend to steadily go up year after year. Last year they fell. I think, there's a few different explanations given. One is companies and regular consumers, mom and pop types had built up a pretty big savings during the pandemic. So they're starting to draw that down. But the other issue for banks, obviously, is these yields on money market funds. So there is quite an interesting competition among banks. The ones that have the wherewithal to raise their rates are raising them. Not all are. Your basic Chase savings account is still at 0.01%. But all of a sudden, these younger, newer banks come out 4.5. I found one above 5%. Right as I turned the story in for edit, Apple and Goldman came out with their high yield savings account above 4%. So it's just amazing how dramatically the opportunity set has shifted for investors. Even just parking your money in the bank can earn you a decent yield these days.
And before we get to Nafis on how money markets work and what it's like to run one, Katie, real quick, you and I have been covering this on the ETF angle. So there's been a flood of money into Treasury ETFs almost before the money market thing happened. So just talk a little bit about the dynamics with cash-like ETFs.
It's been really interesting. I mean, I feel like for the past year, we've been talking about all the billions of dollars going into ultra short duration ETFs. The more interesting thing is that for really all of 2023, it's been the money market funds, the traditional old school mutual money market funds that have been getting the bulk of these inflows versus the ultra short duration ETFs that you and I speak about all the time. But I mean, overall, what really catches my attention is that cash and money market funds and these ultra short duration ETFs for so long, and for good reason, sort of the reputation was this is a place to park your money. This is haven, safety seeking behavior. But that's not the case now. Now this is a yield hunt.
Cash is trash, as they used to say.
Yeah, this is a trade. It's a tactical trade. And so, Nafis, you've seen your world get a lot of flows in the past, like in March 2020. But again, as Katie said, that's normally a fear play. Now they're yielding something. I guess talk a little bit about what it's been like, this, hundreds of billions coming into money market funds. From your point of view, does it change any way you invest? Are you holding the same things you did before? Give us some insight into that.
Sure. Thank you again for the opportunity to speak with you all today. But as noted, over the past month, we've seen tremendous inflows into money market funds. So as an industry, we're up about $375 billion since March 9th. In terms of the way we're investing, the industry as a whole continues to maintain relatively short weighted average maturities. When you consider how quickly interest rates have increased since the beginning of 2022, the Fed's been on this journey to combat inflation, which has been at a 40-year high. You have to go back really to like the 80s or 90s to find as fast of a rate of change in short-term interest rates. So as a result, there's been this enormous incentive to keep money market funds relatively short in terms of interest rate risk, and I think that is true across the industry. In terms of what we've been buying, if you look across the industry and money market portfolios, you'll see some Treasury securities, you'll see repo or repurchase agreements collateralized by Treasury securities. Typically, you'll see a heavy dose of U.S. agency securities. This is primarily the Federal Home Loan Banking System. Is the big issuer in our marketplace, and prime products, which are a little bit riskier than say a government fund or Treasury fund. You'll see some short-term credit like commercial paper or CDs. The opportunity set hasn't necessarily evolved throughout this recent time period. You given Rule 2a-7. So Rule 2a-7 is the SEC regulatory framework that all money funds abide by. And those rules are pretty prescriptive in terms of what a money fund can and cannot do. So you haven't really seen the opportunity set evolve over this recent period.
And Nafis, it's great to have you. And I think it really speaks to this unique situation that we're in, that we're talking about mutual funds on what is an ETF podcast. And I feel like this whole episode has really sort of brought into the light the differences between these structures. That, okay, Eric and I have been talking about ultra short duration ETFs, but that's different from a money market mutual fund. I'm hoping that you can just walk us through some of the key differences, and when we talk about money market funds, what we're actually talking about.
Sure. A money market fund is it's a type of mutual fund that generally seeks to preserve an investor's principal and pay some level of income. Therefore, when we think about money funds, we typically think of them as having lower risk compared to like a fixed income ETF or fund or an equity mutual fund. Money market funds, as I mentioned, typically invest in high quality short-term debt securities that pay income that reflect prevailing interest rates in the marketplace. So money market fund rates typically will be more responsive to changes in monetary policy than, say, like a bank deposit rate. In the U.S., as I mentioned, money market funds are governed by Rule 2a-7 under the Investment Company Act of 1940. Rule 2a-7 dictates limits on many different things that money market funds can engage in. They put a limit on how much interest rate risk one can take, how to define liquidity, how much liquidity a money market fund can hold, and there's a whole host of duties that are listed in Rule 2a-7 that a money market fund manager must comply with. These rules have evolved over recent history to make the industry, much more transparent, much more resilient, which is one of the reasons why money market funds are so popular, particularly when the market is experiencing turmoil like it did back in March of this year or back during the pandemic.
Nafis, as you point out, people turn to money market funds to preserve capital often in times of stress in other parts of the market. And their reputation is pretty spotless as far as safety. The only sort of example I can think of is the reserve fund back in the financial crisis that, quote unquote, broke the buck, meaning the share price actually dipped slightly below $1. I think it was like 99 point whatever. So regardless of, a bank account having FDIC insurance, a money market fund doesn't, but still comes with it that reputation for being more or less riskless. But the one thing I'm wondering is, how are you thinking about this debt ceiling issue as it approaches? Is that sort of the one risk that could threaten a money market fund?
So I think that the debt ceiling is obviously something that we pay attention to. It's something that is on the minds of a lot of market participants. Ultimately, our base case is that this gets resolved and the market will move past it.
Let's go over that dollar NAV. Why is that so important? Because especially if this isn't, the money going into money market funds now isn't for safety, where you'd be like, I need that dollar NAV, I just have to sleep at night. It's a yield play. So why is the dollar NAV so important? Because when you look at the flows in the first quarter, as you said, there were hundreds of billions going into money market mutual funds versus, say, 40 billion into Treasury ETFs. Many of the Treasury ETFs, I got to say, are cheaper. I mean, yours are comparable, but most money market funds are more expensive. We'll get to that in a minute. But why? And also with the ETF, you get intraday liquidity and arguably better tax efficiency. Is the dollar, the stable dollar, really that big of a deal when it's just a trade to get yield?
So it depends on your objective, right? Are you after capital preservation, or are you after a higher return that comes typically with additional risk, right? Like duration risk or credit risk. The stable NAV is important, right? Even with short-term debt securities, right? There's interest rate risk and the potential to see your market value drop in the event of unexpected increase in short-term interest rates. Given that we remain in this heightened inflationary environment and seem to be, far from the all clear from the Fed in terms of getting inflation back down to the Fed's 2% target, there's a lot of value in the capital stability of a money market fund. This is particularly true for investors who may not have the clarity, if you will, as to when they'll need the cash that they have on hand. And you don't necessarily want to be stuck with cash on hand in a floating NAV product right after short-term interest rates have gone up. That said, for investors who are willing to stomach the chance of some capital depreciation or appreciation, there's plenty of ultra short and fixed income options that offer a bit more yield and potential for capital growth. For example, we've seen investors gravitate toward our ultra short term bond ETF, VUSB, which currently yields roughly 20 basis points more than our Treasury money market portfolio. But it's an actively managed fund, right? And that fund seeks to outperform its benchmark, whereas a money market fund is designed for capital preservation. So I think it ultimately depends on what are your objectives.
And one thing I looked at when I dissected the money market mutual fund flows, and it was a little bit of surprise to me, was that the quote Vanguard effect, as I call it, really the physics don't work there. When you look at cash like ETFs or Treasury ETFs, all the money goes to the cheapest products. Like it's basically the asset weighted fee is probably like 7 to 10 basis points. When you look at the money market mutual fund space, and I know you probably love this question because you guys are almost alone in your cheapness. I think yours is 9 basis points. But the one that took in the most money was Fidelity, which is 42 basis points. JP Morgan and Goldman. Again, this isn't really expensive, but when you have ETFs and your fund that's below 10 bips, it just seems like the physics don't work the same here. Why are those money market funds able to sort of still command that fee and largely be immune from the Vanguard effect?
There's probably a few reasons for this. One may simply be the fact that many investors don't think of cash as a traditional investment and therefore aren't applying the necessary or the same cost focus on that part of their portfolios as they would, bond fund or an equity fund. In addition, for much of the last, say, 15 years, and I think this point was made during the opening, money market funds have earned close to nothing, right, or have had their fees waived. We're all of a sudden now in an environment where that is not the case. So might require some additional focus by investors on the fact that yields are higher and costs are lower at a place like Vanguard. So only in the last 12 months or so has Vanguard's cost advantage really become apparent to investors once again. So assuming cash returns stay positive for some duration of time, we do hope that investors will allocate to lower cost, higher quality solutions over time.
I want to talk a little bit about, Mike was speaking about at the beginning, that you've had this impulse for people to take money out of banks, deposits to leave banks and go into the likes of money market funds, which, to your point, it's a place you go where if you want to preserve capital. But we've talked a little bit about the difference between ETFs and money market funds. Maybe you can talk a little bit about whether people should be treating money market funds like they're a bank.
So I think there's a strong argument to be made if you're talking about a specific type of money market fund. And I'm thinking of U.S. Treasury funds or government funds. So Treasury funds will typically invest, at least 99.5% of their assets in Treasury securities, right, or repo collateralized by Treasuries. Government funds will invest at least 99.5% in Treasuries, U.S. agency debt, repo collateralized by Treasuries. I think when you're talking about those types of instruments, there's a strong argument that the risk profile of those products is very similar to a bank deposit. You think about, for a Treasury, right, it's backed by the full faith and credit, right, of the United States. So I think that making the argument that the risk profile of certain types of products is similar to a bank deposit, I think you can make that argument.
Nafis, I'm wondering, so often when you see a deluge of inflows into money market funds, at least back in the low interest rate environment, a lot of people took that as sort of a bullish sign for the stock market and other risky assets, in that there was a lot of dry powder sitting on the sidelines. If there was a correction in the stock market, maybe that would all come back. I wonder if this time is different in your mind, with people actually parking it there in many cases for the yield rather than the safety. Are those flows a little bit more sticky this time compared to, say, the previous 10 years after the financial crisis, when it really was just a capital preservation play?
Yeah, I think it depends on how things evolve here in the short term. When you think about what's on the horizon, many economists are forecasting for, mild recession at some point this year, possibly into early next year. When that's on the horizon, that creates an incentive, right, to stay short, to kind of focus on capital preservation. So I would say that I would expect money market fund assets to generally be sticky here in the short term, and then really it just depends on how the economic environment evolves over the next 6 to 12 months. So
besides people who are short the market, you must be one of the rare people actually rooting for Fed hikes.
I think the Fed should do whatever they think is in the best interest of economic conditions.
All right. Your PR guy signed off on that one. Well done. Interestingly, so I researched Bogle intensely for a book I wrote recently. And one of the things, I didn't really cover this in my book too much, but when I read his book, Character Counts, he gives speeches. It's all his speeches over the years. In like 82, 83, Vanguard's has no money, basically. They're very small. But their money market funds start to become an early hit for them. And he says, I quote, "The banks want their money back. They don't like it." And so that's when banks started launching mutual funds. Vanguard was about to steal a lot more money, but they obviously got smart and came out with those themselves. So I guess in that whole reputation or history of challenging the banks for their money, as Mike's question just alluded to, do you think the pressure's on them to raise their rates? What do you think those internal conversations are like? Because you have the interest income, which is great revenue. You raise rates, you're going to lose, you're going to cut into that. But you have to also balance it with losing money to money market funds.
Yeah, it's a great question, and unfortunately, I'm not a bank CFO or treasurer, right? So I can't speculate as to why a bank may or may not increase their deposit rates, right? But at the end of the day, in my mind, it comes back to what is best for investors. When I look at our money market fund lineup, which is a government money market fund lineup, these are extremely safe, extremely stable products that pay a very, very competitive rate of interest. And so I think that's ultimately what it comes down to, is that investors should, to the extent that they have cash balances, make sure that cash is working for them, make sure that the costs that they're paying are reasonable. And if they're not, they should seek out a low-cost option like a Vanguard money market fund.
I got to say, I think I would rather be in your shoes, Nafis, than being a bank treasurer. Just putting that out there. But to your point that you're not a bank, something that the bank executives talk about a lot, and which we heard on the latest round of earnings calls, is that deposits tend to be sticky. And when you think about just this incredible amount of money that's come into these funds, how sticky would you expect that to be when, maybe we start to get into some of the environment that Mike has talked about, that, maybe equities start competing again, or maybe the Fed finally does cut rates? Do you expect these newfound inflows to stick around, I guess?
So speaking from my experience, I would expect the cash to be sticky. Here at Vanguard, one of our philosophies, right, is being disciplined, right, with respect to your goals, right, in your asset allocation. Typically, our investors will hold on to their accounts for a long period of time. So it'd be my expectation, given that our flows tend to be more retail oriented, that the cash would be relatively sticky. Here in the short to medium term, I wouldn't expect to see a massive outflow cycle.
Well, I'm thinking about sort of my own accounts, the 529 accounts I have, and you're only allowed to rebalance them a couple times a year. So that helps to some degree, I imagine, if you have a bit of a captive audience there. But I'm also wondering, Nafis, to the extent that you are seeing these inflows, do you have any sort of insight or color on where they're coming from, how they're arriving there? Are there RIAs out there who are really advising clients to go to cash at this point, or is it self-directed accounts, do you think, that are just noticing these yields on their own? Any insight on what is creating these flows?
It's a great question, and to be honest, I don't have great insight. Our investor. We have 30 million investors here at Vanguard, and ultimately my job is to manage the cash consistent with the mandate. Yeah, I did make a comment that our investor base tends to be somewhat more retail oriented, but in terms of the specific channels through which that cash is coming, unfortunately, it's not something that I have a lot of insight into.
Probably a little all the above to some degree, I would imagine, too.
That would be my guess.
Yeah, and I think broadly, institutions, especially when you see money market funds grow like by $600 billion in a quarter, I feel like there has to be some big fish in there. I don't know if retail's capable of that level of movement. I have a question from someone on my team who asks about the currency market moves. Given that the euro and the pound are up 3% versus the dollar, does the currency market impact anything you do?
We do see some impact. I'm not an FX expert, candidly, but you do see some impact insofar as if the cost of dollar funding changes. You'll see this where banks will alter their mix of issuance. Right, they might tap the U.S. markets when it's more favorable. They might tap other markets if FX changes. But from our perspective, these are obviously U.S. money market funds that I look after. So yeah, it's difficult to comment on changes in individual interest rates and how that impacts us.
So talk to us a little bit, Nafis, about what the team looks like managing this fund for just 9 basis points. I'm picturing a pretty small, nimble team.
It's just you, right? I got to think, right? Otherwise, you're not getting paid that much.
So we're a team of 6. There's two portfolio managers and 4 traders. Most of us are based here in Malvern. We have a few traders in our Scottsdale office. But we're one team of 6 across, spread across the country that's, simultaneously looking after, one book of business for Vanguard. Those are just the folks who are, who have hands on the assets, who are actually trading the assets. There's a bigger team that supports us. We have a pretty robust credit research capability. That's a global capability where we have a team of analysts and research associates that are helping us do due diligence on issuers that we invest in. We have a investment strategy group that helps us with economic research. So as we've grown and as we've been able to increase our scale, that allows us to keep costs low, right, and have these additional resources to help us manage money market funds.
So a basis point and a half for each of you, I guess. That's a great sound.
Yeah, but when it's, how much does it have in assets? Like $1 trillion? It does add up.
Sounds good. I would take that.
Yeah, I'll take that.
But Fidelity's money market fund, just one, kicks out $1 billion a year in revenue. I did the numbers. Only the Capital Group American Growth Fund of America, which is the largest active managed fund in the U.S., I believe those are the only 2 funds that kick out $1 billion. That was more my point. I'm surprised. Not 42 bips isn't that much, but when you have that much money in it, it does kick out a lot of revenue. So the dollar fees are just ginormous on some of these funds. Mm-hmm. I think there is some degree of a captive audience, as you said, that doesn't exist in the ETF world, where the customers are able to just move around at their will much easier.
Yeah, I mean, when you think about just the discrepancy in flows that we've been talking about, it must be some of those sorts of factors. Because if you just do the numbers, if you lay out the math there, it is a head scratcher.
It's interesting. So we looked at all of the mutual fund companies by flows in the first quarter. And believe it or not, Fidelity was number 1. Fidelity has seen outflows out of their active, but inflows into their index funds. So they've been balancing out a lot. So typically they're not number 1. They might be on the list somewhere. Number 2 was somebody been JP Morgan. UBS was on there. Vanguard was 6th, which is rare to see Vanguard 6th. But the percentage of the flows from money market funds, Vanguard was way an anomaly. Only 42% of their flows came from money funds, whereas everybody else was above 85%. Wow. So this money market fund surge has completely created this distortion in the normal sort of leaderboard activity, at least for the first quarter. And we thought that was interesting. We dig in through the numbers. I got to say, although when you write, no offense, Nafis, but when you write about money market funds, it doesn't really get the readership.
Oh my
So
gosh.
my reads are down this quarter, unfortunately, but this is the big story.
Well, Nafis, I know it's not in the Vanguard ethos necessarily, but when you hear Eric say things like that Vanguard is number 6, can you believe it? I mean, does that fire off any competitive juices on your part?
So when looking at the flows, I guess I would encourage to maybe go a level deeper. And, if you consider kind of the institutional retail breakdown in the flows, institutions have, definitely dominated some of the flow activity, which I think explains some of the numbers that you pointed out. When you look at it from a retail perspective, I would say, Vanguard has captured its fair share. So I would just encourage, just taking a look sort of under the hood when you're looking at cash flow data. To answer the question about competitive juices, if you will, at the end of the day, we try to do the right thing for all shareholders. We do have an investor base that tends to be very, very disciplined, that tends to be rather sticky, and we think that that is the best approach for managing our money market fund business.
Yeah, I don't know if does competitive juices get you disqualified from your job application at Vanguard?
I want to win.
But Nafis, we're talking about sort of the salad days, the glory days for money market funds right now. Not too long ago, it was the opposite story. I mean, there was a lot of talk about, these funds might actually have to go to a negative yield because rates were so low. It was actually difficult to manage one of these funds and still charge any basis point fee at all on customers. Talk to us about how difficult it was not so long ago to manage a money market fund and keep that yield positive.
So you made the comment about the differences in fees. And so from that perspective, I would say it was much less difficult for a place like Vanguard, given that we enjoy this expense advantage.
Right.
When you look more broadly across the industry, I think that this is the reason why the SEC will soon be publishing a new round of reforms in this space, and one of those reforms is aimed at money market funds being able to weather when interest rates do get very, very low. But when I look at the experience that we've had over the past, say, 15 years during periods of zero interest rate policy, we really have not had that difficult of a time managing our funds.
So, Nafis, we have a fun way of ending the podcast, which is we ask every guest, what is your favorite ETF ticker? I realize as a money market mutual fund analyst, that could be a stretch, but do you have one?
My favorite ETF ticker, it's going to have to be a Vanguard fund. I'll go ultra short, VUSB.
Nice.
First person in 5 years to ever pick that one. So congratulations. And that's not only normally we don't let you pick your own companies, but because you're a fund, I'll let it slide. And that was such a novel choice. So anyway, Nafis, Katie, Mike, thanks for joining us on Trillions today.
Thank you so much. It was great to be here.
Thanks.
Loved it.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, and wherever else you like to listen. We'd love to hear from you. We're on Twitter. I'm at Joel Weber Show. He's at Eric Balchunas. This episode of Trillions was produced by Magnus Hendrickson. Bye.